Hi, today I'm going to talk about a really big theme, something that's likely to affect portfolios for 10 or 20 years. It isn't a day-to-day issue, but it is a framework that we have to fit your investments in to try and make them successful over the long term. I want to talk about globalization, and by that I mean the increase in trade flows we've seen internationally over the last 20 to 30 years. I think it's about to reverse, and I think that's going to have a really big impact. Globalisation has been a really big factor because it's grown so much over the last 20 to 30 years. It's really been driven by three very large countries, Germany, Japan and China, who have an export-orientated growth model. So they've deliberately pumped up exports as part of their way of growing GDP. And that has led to very large trade surpluses and all sorts of knock-on effects that have had a really dramatic impact on how all of us live. Now, in my view, these trends are about to reverse, and all of the effects that we saw in the last 20 to 30 years, to some extent, they will reverse. It's very significant for our economy and our portfolios, and it's something that very few people seem to have cottoned onto. The first effect is globalization led to disinflation or downward inflationary pressure in goods. So once we opened ourselves up to global manufacture, goods over time became cheaper, as you see with washing machines and TVs. The second directly related effect is opening up our markets to global goods manufacture, opened up large sections of places like the UK's economy to global wage competition, which has led to very low wage growth for large sections of the UK economy, which is extremely important politically. And the last thing is capital. In order to sustain a trade surplus, you have to have an equal and opposite capital outflow, which really means buying assets in places like the UK and the US. So this mechanism of trade surpluses being recycled into capital inflows has led to an awful lot of money pouring into asset markets in places like the UK and US. And of course, that's driven up asset prices. Now, as these trends reverse, it doesn't take much to imagine that could have a very significant impact on our portfolios. So many of you might be thinking, why do we think globalization is going to end? Well, I think there are three reasons. One is geopolitical. So some of the most important export-orientated countries like Russia and China definitely consider the West to be their foe, and they're taking actions to protect what they see as their national interest. Now that is directly in competition with our national interest. So if you are reliant on China for sourcing goods into your company or your supply chain, there's a lot of political risk there. So companies are already cutting back on their China exposure, and I think that will only continue to increase. The second thing is COVID showed the vulnerability of international supply chains. If anything goes wrong with the port infrastructure or with international shipping, then it can have a very detrimental impact on your business. So again, that's driving businesses to onshore or nearshore production. And the last thing is politics. What we've seen with massive downward pressure on wage growth is we've seen populations in places like Europe and the US reach breaking point. And it's what commentators call the rise of populism, but really what it is people saying we want better wages and better conditions for large sections of people that live here. Now, you don't need to study politics too much to see that this is an international trend. And what does populism mean? It means protecting your own people, increasing wages. These things are partly going to drive deglobalization as well. So a retreat from globalization, in our view, is going to be quite negative for investment markets for three reasons. Persistently higher inflation is always bad for assets like the stock market and the bond market. Higher wages, good for cohesiveness within a country, but bad for corporate profitability. Of course, that's bad for the stock market. And lastly, less capital. If you reduce the trade surpluses of the big export nations, you reduce the amount of money that's coming into markets and being invested into companies and bonds. That will be bad for asset prices. So this transition from a globalized to a less globalized world is going to be painful. That's why we are playing defense in our portfolios. And we expect markets will be weak in the over the next year or so, but at some point we think we will get a great opportunity to increase risk at attractive prices and then drive returns for clients from that level. So not all is lost, but I just want to reiterate the reasons why we're being so defensive in our portfolios right now and why we're not changing tack. If you've got any questions about this, as always, please get in contact with me. I'd be delighted to speak to you. If you want to see our content on an ongoing basis, subscribe, click on the icon, subscribe to our feed. And lastly, as always, I am talking about investment markets and you must be aware that your capital is at risk. Thank you.